Warren Buffett has sold more than 50% of Berkshire's Apple stock in 2024, dropping his total investment from $174 billion down to just $84 billion. Why did he sell? In this video, I'll share some data that likely explains Buffett's reasoning. Hi, my name is Brian Feroldi. I'm a financial educator who's been analyzing and investing businesses for more than 20 years. Now let's state the obvious. Warren Buffett clearly believes that Apple is a wonderful business. As recently as the first quarter of this year, Apple was his biggest portfolio holding, more than 41% of his total portfolio. That's more than triple his second biggest investment. Moreover, if you look at Apple from a fundamental basis, it checks nearly every single box that Buffett looks for when analyzing an income statement, balance sheet, and cash flow statement. So since Apple is a great business with a wide moat, excellent management team, and strong capital return programs, his reason for selling is likely almost entirely due to Apple's valuation. So Buffett likely believes that Apple is overvalued today, and I have some data that backs up why he probably thinks that. So when valuing any business, the first question to ask is where in the business growth cycle is that company? Now, Apple is very clearly in the capital return phases, which means that there are lots of different ways that we can value the company. We could use its multiples, like its PE ratio. We could use yields. We could use reverse DCF modeling. So let's take a look at Apple's numbers using some of those methods. Now, Buffett first started buying Apple way back in 2016 at a split-adjusted price of about $26 a share. More recently, this stock is around $219, and on a total return basis, Buffett has clearly hit a home run with Apple, earning multi-bagger returns during that time. However, if we take a look at Apple's price to earnings ratio, he was buying way back here in 2016. And that was when Apple stock was trading for between 10 and 12 times earnings or so. So this was when Buffett was buying a meaningful position in the company. Over the last decade, Apple's PE ratio has ballooned, and more recently, it's traded over 33 times earnings. So it's triple the valuation when Buffett first started investing. On the PE ratio basis, Apple's stock is clearly trading at a much higher valuation today than it did previously. Now, we can also see this taken out when we take a look at the company's buyback yield. This is Apple's buybacks, how much of the company's market cap is being retired each year. Now, back in 2016, the company was retiring about 7% of its value each year due to buybacks. Now, this number has certainly fluctuated, but the overall trend has been down. And more recently, even though Apple is spending billions of dollars on buybacks, it's only retiring about 2 to 3% of the shares here. That is significantly less than it was previously, and this is almost entirely due to the company's valuation creep. Now, another way of measuring this is by looking at the company's dividend yield. So back when Buffett was buying, the dividend yield on Apple stock was well over 2%. And since the stock has just appreciated so much, even though the dividend payments have increased, the yield today is under 0.5%. So when we look at PE, buyback yield, dividend yield, clearly the valuation today is much worse than it was. Now, how about from a growth perspective? Let's take a look at Apple's revenue. So back in 2016, Apple was generating about $215 billion in revenue annually, and that was actually down from the year prior due to the iPhone upgrade cycle. Now, more recently, Apple is generating about $385 billion in revenue. But if you look at the overall trend, there was pretty strong growth for a couple of years. But over the last couple of years, the growth rate has really slowed down. And if we measure that just purely on a percentage basis, how fast was the company growing? Buffett started to buy here when the company's revenue actually declined. And then we saw 6%, 16%, 2%, 5%, 33%. So strong growth rates, but those growth rates have really tapered off. So it's likely that Warren Buffett believes that Apple's valuation today and its earnings, price to earnings ratio today, don't justify the company's current growth rate. Now, it's worth noting that in the past, Warren Buffett has held on to some of his top holdings, even though they traded at silly valuations. And he himself admits that he made a mistake with one of his favorite companies of all time, CocaCola.
As a really wonderful business that sold at a very silly price some years back, and you can definitely fault me for not selling the stock. I always thought it was a wonderful business, but clearly at 50 times earnings, it was a silly price on the stock.
Now, Buffett was referring to Coca-Cola's stock price in 1998. At the time, it was trading for about $43 per share and about 50 times earnings. Now, as you can see from the chart here, the company's stock didn't reach that price until 2014. So it was a 16-year period of shareholders effectively getting a very low or negative return on Coca-Cola stock, even though it was wonderful business. Now, Buffett has a great quote on this. A too high purchase price for the stock of an excellent company can undo the effects of a subsequent decade of favorable business developments. In other words, if the valuation is too high, even if the company succeeds, you, the investor, might not. So Buffett's selling clearly indicates to him that Apple's valuation today is unfavorable and the company is unlikely to earn investors a superior return given today's high valuation, even though Apple, the underlying business, remains absolutely excellent as a company. Well, I hope that you enjoyed this video. Now, I made a very simple PDF download that has all of Warren Buffett's financial statement rules of thumb on them. If you want a free copy of that PDF, just visit longtermmindset.co/Buffett and I will send you a free PDF. Thanks for watching. See you in the next video.